The number $77 just broke the financial system. Banks are scrambling. Traders are liquidating billions. And your money? It's caught in the crossfire of the biggest precious metals crisis in modern history. December 30th, 2025. Silver hits $84 per ounce, a record that sends shockwaves through Wall Street. Within hours, the CME Group, the world's largest derivatives marketplace, makes an emergency move. Margin requirements skyrocket by 30%. Traders holding billions in positions face a brutal choice: post more cash or liquidate everything. By the time markets close, silver crashes 17%. But here's what they're not telling you. This isn't the end. This is the beginning of something far bigger, far more dangerous, and completely unavoidable. If you want to understand what is really happening before your savings get caught in the blast zone, hit that like button right now. Subscribe and turn on notifications, because this story is moving faster than the mainstream media can cover it. And drop a comment below. Tell me if you're seeing silver prices spike in your area, because what happens next affects every single one of us. Let's start with the number that changed everything: $77. In early January 2026, silver prices hover around this seemingly arbitrary figure. But to those who understand the inner workings of the commodities market, $77 isn't just a price, it's a tripwire. When silver crossed this threshold in late 2025, it triggered a cascade of margin calls, forced liquidations, and emergency interventions that exposed just how fragile the entire system has become. Here's the reality. Silver surged 147% in 2025 alone. It opened the year at $28.92 per ounce and closed above $72. That's not a normal market move. That's a vertical rocket shot fueled by forces most investors don't even know exist. By December 30th, silver hit an all-time high of $84.01 before the system slammed on the brakes. But why $77? Why did this specific price point send banks into panic mode? The answer lies in derivatives exposure. Major financial institutions, particularly JP Morgan, which paid over $920 million in fines for manipulating precious metals markets, hold massive short positions in silver futures. When prices rise beyond certain thresholds, these positions become underwater, losses mount, margin calls arrive. And suddenly, banks that are supposed to be too big to fail find themselves hemorrhaging cash. The CME Group's emergency margin hike wasn't a coincidence. On December 26, 2025, they raised initial margin requirements for March 2026 silver futures from $20,000 to $25,000 per contract, a 25% increase. Days later, they hiked it again. This forced traders holding leverage positions to either inject massive amounts of new capital or close their trades at devastating losses. And here, it's the kicker. This margin squeeze extracted approximately $675 million from the market in a matter of days. Traders who thought they were riding the silver wave suddenly found themselves drowning in margin calls. Fortunes evaporated, accounts were liquidated, and the mainstream financial media barely mentioned it. Now let's dig deeper into what's really happening beneath the surface. Because the 77 price trigger is just a symptom of a far larger disease eating away at the global financial system. Silver is in its 5th consecutive year of supply deficit. That means demand exceeds supply by a lot. In 2025, global demand for silver reached 1.24 billion ounces. Global supply, only 1.01 billion ounces. We're burning through silver reserves at a rate of approximately 230 million ounces per year, and there's no cavalry coming to save us. Mine production remains flat. New discoveries are rare, and the silver that exists is being consumed, not hoarded. Where is all this silver going? 3 unstoppable industrial sectors: solar panels, electric vehicles, and artificial intelligence data centers. Let's start with solar. Each solar panel contains roughly 0.64 ounces of silver. In just the first half of 2025, photovoltaic demand alone consumed 448 million ounces. Solar technology now accounts for 14 to 15% of global silver demand, up from just 5% a decade ago. And with governments worldwide pushing aggressive renewable energy targets, solar demand is projected to grow at an accelerating pace through 2026 and beyond. Electric vehicles are the second demand driver. Each EV requires approximately 25 to 50 grams of silver for electrical contacts, battery systems, and charging infrastructure. The Silver Institute estimates automotive silver demand will grow at a 3.4% compound annual growth rate from 2025 to 2031, with EVs overtaking internal combustion engines as the primary demand source by 2027. And then there's AI. Data centers, those massive warehouses filled with servers powering everything from ChatGPT to TikTok, are silver-hungry beasts. Every server, every circuit board, every high-speed connection relies on silver's unmatched electrical conductivity. As AI explodes, so does the need for silver. This isn't speculative demand, this is industrial consumption. Once silver goes into a solar panel or circuit board, it's gone. It's not coming back to the market. According to data compiled by American Bullion, industrial silver demand in 2025 exceeded 700 million ounces, a record high, and analysts expect this to climb even higher in 2026. Roughly 50 to 60% of annual silver demand now comes from technology and manufacturing, making silver less of a precious metal and more of a critical industrial commodity. But here's where things get truly bizarre, and this is the part Wall Street doesn't want you to understand. There are two silver markets operating simultaneously, the paper market and the physical market. And right now, they're tearing apart at the seams. The paper market consists of futures contracts, ETFs, and derivatives traded on exchanges like the COMEX. These are essentially IOUs, promises to deliver silver at a future date. The physical market is actual metal, bars, coins, bullion sitting in vaults. And here is the shocking reality. The gap between paper prices and physical prices has exploded to unprecedented levels. In early January 2026, while COMEX silver futures traded around $77, physical silver in certain markets, particularly in Shanghai, China, commanded premiums of $50 to $60 per ounce above the spot price. That means real deliverable silver was trading at $130 or more, while paper contracts sat at $77. This is the great silver disconnect, and it signals something deeply broken in the system. Why the massive premium? Simple. There isn't enough physical silver to meet demand. Vaults are being drained, refineries can't keep up, and the biggest player in the global silver market just threw a hand grenade into the room. On January 1st, 2026, China implemented sweeping new export restrictions on silver. China controls an estimated 60 to 70% of global refined silver supply. Under the new rules, only 44 approved companies can export silver, and each shipment requires government licensing. This is China weaponizing a critical resource, and it's working. Even Elon Musk sounded the alarm, posting on X, "This is not good. Silver is needed in many industrial processes." The impact is immediate and brutal. Silver that once flowed freely from Chinese refineries to global markets is now bottlenecked. Shanghai premiums have spiked. Western manufacturers are scrambling. And analysts warn that if China decides to fully restrict exports, we could see a force majeure event, a legal declaration that contracts cannot be fulfilled due to extraordinary circumstances. Translation: paper contracts promising silver delivery could default en masse. Market analyst silver stock investors Krauth predicts silver could break $125 per ounce in 2026, with Shanghai shortages potentially triggering price shocks that cascade through the global system. The Oregon Group and analyst Anthony Milewski have published research exploring scenarios in which silver reaches $150 per ounce in 2026. These aren't wild-eyed conspiracy theorists. These are serious market analysts citing structural supply deficits, persistent industrial demand, and geopolitical supply disruptions. Now, if you think this crisis appeared out of nowhere, you haven't been paying attention to history. The silver market has been manipulated for decades, and the proof is public record. In September 2020, JP Morgan Chase admitted to criminal wrongdoing and paid over $920 million to settle federal charges of market manipulation. The charges? Spoofing, a practice where traders enter fake orders to manipulate prices, then cancel those orders before execution. JP Morgan's precious metals desk engaged in this illegal activity for years, artificially suppressing silver prices while accumulating massive physical positions. Here is how the scheme worked. JP Morgan traders would flood the market with large sell orders, creating the appearance of overwhelming supply. This would drive prices down. Other traders, seeing the selling pressure, would panic and sell their positions. Once prices dropped, JP Morgan would cancel their fake orders and buy silver at the artificially depressed price, rinse and repeat for years. Former JP Morgan precious metals traders, Michael Nowak, Greg Smith, and others were criminally charged. In August 2023, 2 former traders were sentenced to prison for fraud, attempted price manipulation, and spoofing. The U.S. Department of Justice called it a massive multi-year scheme to manipulate the precious metals markets. But here I'll just S the truly infuriating part. While JP Morgan was manipulating prices downward and paying fines, they were simultaneously accumulating the largest private stockpile of physical silver in the world. Market estimates suggest JP Morgan now holds somewhere between 600 million and 750 million ounces of physical silver in private vaults. That's roughly 60 to 75% of annual global mine production. They manipulated the market to buy cheap, and now they're sitting on a silver mountain as prices explode. Some analysts believe JP Morgan has now flipped from short to long, meaning they are no longer betting against silver, but betting on its rise. If true, this is one of the most spectacular market manipulations in financial history. Suppress prices for a decade, accumulate a massive position, then watch as structural deficits and industrial demand send prices to the moon. Let's bring this back to you. Why should you care about margin calls, supply deficits, and Chinese export restrictions? Because your money is directly at risk. If you own silver ETFs like SLV or similar funds, you don't actually own physical silver. You own shares in a fund that supposedly holds silver. However, as the paper-physical disconnect widens, the risk increases that these funds may not contain the metal they claim. If a run on physical silver occurs, if investors demand delivery en masse, these funds could fail spectacularly. You'd be left holding worthless paper. If you hold cash savings in banks, you're exposed to inflation and currency devaluation. The US dollar index fell sharply in 2025, posting its biggest annual drop in 8 years. Foreign central banks are dumping US treasuries at record rates. Interest costs on US debt just hit $1.21 trillion annually. These are signs of a currency under severe stress. When the dollar weakens, hard assets like gold and silver surge. Silver gained 147% in 2025. Gold climbed 64%. Your cash? It lost purchasing power every single day. And if you're invested in equities, you're about to face a reckoning. Legendary trader Todd Horwitz recently predicted a 40 to 60% massive collapse in stock markets, with gold soaring to $6,000 per ounce by late 2026. Bank of America strategist Michael Widner forecasts gold averaging $4,138 per ounce in real terms throughout 2026, with silver and platinum prices rising in tandem. JP Morgan Global Research predicts gold pushing toward $5,000 per ounce by the fourth quarter of 2026, with $6,000 a possibility longer term. These aren't fringe predictions. These are mainstream financial institutions warning that the old playbook is dead. The rules have changed. And if you're not positioned correctly, you're going to get crushed. So what happens next? Where does this crisis lead? There are 3 possible scenarios, and none of them are comfortable. Silver prices consolidate around current levels, margin requirements stabilize, and the market absorbs the supply deficit gradually over several years. Industrial demand continues to grow, but new mine production and recycling efforts slowly bring supply and demand into balance. This is the optimistic scenario. It's also the least likely. Physical shortages intensify. China tightens export controls further. COMEX and other exchanges face delivery failures. The paper-physical disconnect becomes untenable, forcing a dramatic repricing of silver. Prices spike to $125, $150, or even higher as industrial buyers panic buy whatever physical metal they can find. ETFs collapse, lawsuits fly. Small investors get wiped out while those holding physical metal see life-changing gains. This scenario is looking increasingly probable. The silver crisis becomes the canary in the coal mine for a broader collapse of confidence in paper assets and fiat currencies. Investors flee into hard assets. Gold and silver prices explode. The US dollar loses reserve currency status. Central banks scramble to stabilize markets, but trust is shattered. This is the doomsday scenario, and while it sounds extreme, the warning signs are flashing red. Forbes published an article titled US Dollar Collapse Crisis Warning, predicting exactly this outcome. The Federal Reserve's balance sheet is bloated. Government debt is spiraling, and precious metals are screaming that something is very, very wrong. Robert Kiyosaki, author of Rich Dad, Poor Dad, predicts silver reaching $200 per ounce by 2026. While that sounds outrageous, consider this. Silver opened 2025 at $28.92 and closed above $72. That's a 149% gain in 1 year. If industrial demand continues accelerating and physical shortages worsen, a move to $200 isn't impossible. It's mathematical. All right, let's talk action steps. What should you do with this information? First, understand the difference between paper and physical. If you want exposure to silver, consider buying actual bullion, coins or bars you can hold in your hand. Store it securely, preferably outside the banking system. Paper claims may fail. Physical metal won't. Second, diversify your risk. Don't put all your wealth into any single asset. Silver is volatile. It can swing 10 to 20% in a matter of days, as we just saw with the margin call crash. Balance your portfolio with gold, real estate, productive assets, and yes, some cash for liquidity. Third, stay informed. This story is moving fast. CME margin requirements, Chinese export policies, industrial demand data, these factors change weekly. Follow credible sources. Ignore hype. Focus on fundamentals. Fourth, prepare for volatility. Silver might hit $150. It might crash back to $50. No one knows for certain. What we do know is that the structural forces driving silver higher, supply deficits, industrial demand, geopolitical tensions, aren't going away. If you believe in the long-term thesis, be prepared to stomach wild price swings along the way. And finally, ask yourself this question. Do you trust the system? Do you believe central banks can manage debt loads measured in the trillions? Do you think paper currencies will maintain their purchasing power? Do you trust that ETFs and futures markets will honor their promises when the chips are down? If the answer is no, then silver and gold are your insurance policies, not investments. Insurance. The kind of insurance that's saved civilizations for 5,000 years when everything else collapsed. Here's the final piece of the puzzle, and this is the one that should keep you up at night. The silver crisis of 2026 isn't an isolated event. It's a symptom of a much larger breakdown in the global financial system. For decades, we've lived in a world of cheap money, endless debt, and the illusion of infinite growth. Central banks printed trillions. Governments borrowed trillions more. And the bill? It's coming due. Silver is the pressure valve. It's the market screaming that something is fundamentally broken. When a metal that trades at $77 on paper commands $130 in physical form, that's not a market inefficiency. That's a warning siren. The banks know this. That's why JP Morgan spent years accumulating physical silver while manipulating prices. That's why CME raised margin requirements in a desperate attempt to cool the market. That's why China weaponized silver exports. They all see what's coming. The question is, do you? In the next 12 months, we're going to witness one of the most dramatic wealth transfers in modern history. Those holding hard assets will prosper. Those holding paper promises will suffer. Those who ignored the warning signs will be blindsided. The 77 trigger wasn't the end of the silver story. It was the opening chapter. And what comes next will determine whether your wealth survives or evaporates in the great reckoning of 2026. Silver just crossed $80 again as I record this. The volatility is intensifying. The physical shortages are worsening. And the banks? They're panicking behind closed doors while telling you everything is fine. Don't believe them. Believe the numbers. Believe the deficits. Believe the history of manipulation, the export restrictions, the margin calls, and the paper-physical disconnect that's tearing the market apart. Your move, your wealth, your future. If this video opened your eyes, smash that like button and subscribe right now because this story is far from over. Comment below with your thoughts. Do you own silver? Are you buying more? Are you worried about your savings? Let's have that conversation because we're all in this together. Share this video with anyone you care about who needs to understand what's really happening. And remember, the system won't save you, but knowledge, preparation, and action might. This is the silver collapse alert they don't want you to see. Now you've seen it. What you do next is up to you.